Hi, how are you? My name is Julio with Bookkeeping. I specialize in e-commerce bookkeeping for Shopify stores. In this video, I want to talk about financial statements, why they're important, and why we have to produce them at the end of every month. So what are financial statements? They are monthly financial reports that help you keep on pulse on the financial health of your business. These statements give us different information about our business, right? So the first one would be the balance sheet. The balance sheet is basically a photograph of a company at a particular date. And the balance sheet equation is assets equals liabilities plus equity. Now, what are assets? Assets is what you own. They're resources owned by the company to have future economic value. So assets could be made up of cash, investments, accounts receivable, inventory, and equipment and property. So those are assets. They're what you own. Then we have liabilities, right? Liabilities are what you owe, right? So they represent companies' obligations. This could be made up of accounts payable. They can be debts. They can be loans, long-term debt, and accrued expenses. And then we have equity. Equity can be retained earnings or any capital contributed from like the owners or shareholders who has the right to the net worth, basically. So the net worth. So that's the balance sheet, right? So it's important to investors, managers, and creditors. The balance sheet really helps understand the company's financial position and the ability to meet short-term and long-term obligations. And it's really the value of the business, but we need to look at other statements, right? So that brings me to the next statement, which is the income statement. The income statement, it's revenue minus expenses and equals income, right? So the income statements tells us what occurred during a period, right? For let's say if we're doing October, what happened from October 1st to October 31st, right? How did the company perform in that period? So basically, the sales, the expenses, and the income. It's a simple equation, but if you dig deep, you'll find the answers you're looking for, right? So there's more information in each part. So basically, the revenue represents the total amount of money generated from a sale of goods or services. If you want to dig deep into this, you can see what percentage was goods, what percentage was services, what goods stand out the most, right? And then you have to look at expenses. This is the cost to create the revenue, right? To generate the net revenue. You could look at the operating expenses, cost of goods sold, marketing, salaries, administrative expenses. So those are expenses, and then income, it's what you're left with after taking all the expenses from the revenue, right? So this shows you what occurred during that period, and it shows you how the company performed. This statement impacts assets and liabilities, right? Because if you have expenses, for example, that let's say you're buying things on credit, if you're buying material on credit, or let's say you're selling on credit as well. So basically, the income statement shows you how resources are earned or dispersed during a period. This statement shows the ability of a company to generate income and manage cost effectively. So this also helps with the financial health of a company. The next statement is the statement of cash flows. This statement fills the gap between the balance sheet and the income statement. As the name of the statement says, this is cash flows. It only focuses on cash. This is how much cash was generated or spent on operating activities, investing activities, or financing activities. So what this statement is showing is the cash inflows and cash outflows. It's not taking into account accounts payable, accounts receivable, different things that are non-cash transactions, basically, right? So operating activities is shows the cash generated from the company's core business operations. That's operating activities, right? So what the company is actually doing. If it sells pencils, it's the cash from selling pencils. Then investing activities. So for example, this could be for the purchase of or sale of a long-term assets like property, equipment. Let's say you purchase equipment or you purchase a plant. That's an investment. That's not your core. That's not operating, right? That's not what you're in business to do. And then financing activities. This section focuses on the cash flow. Financing activities could be like something with stocks, like purchasing stocks or issuing stocks. You can be repaying loans or dividends to shareholders, right? So that's statement of cash flows. Operating, investing, and financing activities. It's the ability of a company to generate cash. It shows if it's investing in growth and and it can meet financial obligation. And the last one is the statement of retained earnings. This is the changes in the retained earnings amount during a given period. These are the profits left over after paying out dividends to shareholders. So basically the equation or the way it works is beginning retained earnings plus net income minus dividends equals the ending retained earnings. And it provides an insight into a company's long-term financial performance and its ability to reinvest profits into the business for growth and expansion. So these are the financial statements that every company should produce, right? So this gives them a better understanding of how their company is doing, gives them the financial health of the company and shows them how they're performing. And then you can compare also, to previous month or the previous quarter or the previous year, see if you're growing, see what percentage you grew. The reason why it's important to produce this statements is just so you have something to compare. If you're not producing statements, you can't tell if you're growing, and you can't compare, you can't drill down. Now, statements are important, and the way we're able to have good financial statements is by having a good bookkeeping. So it's important to categorize things the right way. It's important to put things in the correct account, right? It's important to keep track of our books. It's important to keep on top of everything. It's like the saying goes, garbage in, garbage out. So if you don't have good bookkeeping standards, your financial statements, the data in it won't be reliable. Your income statement could look like you're overstating it or understating it if you don't do good bookkeeping. So that's the importance of financial statements, and even more the importance of bookkeeping. Good bookkeeping is what will give you good financial statements. So I just wanted to show you that. I just wanted to show you the 4 statements that you should be producing to compare and to look at what you could be doing better, right? And again, it's important to have good bookkeeping so these statements can be accurate. With that being said, thank you for your time. I'll see you in the next video.